to see some of those people and not some others. If there are questions from the people that you don't see, I'll convey that. But it's a wonderful, well, it really is wonderful to have Eric Leeper here. He is one of my heroes. The earliest paper on active monetary policy, passive fiscal policy, vice versa, determinacy, whatnot, I think is one of the best papers ever written. And he's kept up with that quality and insightfulness ever since. He is also the one who shows up in, state central banker conferences where everybody wears the same Navy suit in Hawaii shirts. But we've been wanting to have him here for a while. This doesn't count. Hopefully he'll be here in person. But it's almost like a very nice mini course that last week we had Bianchi speaking of his work on how to create inflation and how to do essentially inflation funding of fiscal policy. And today we're going to see an application of that and how it has actually worked in history together with its theoretical background. So Eric, welcome. It's wonderful to have you here. And we're all used to Zoom seminars. It's a seminar like any other seminar, meaning we will heckle you. Pleasure to have you. Go ahead.
Okay, and right now my dog is heckling me, so you'll have to excuse that.
You're not referring to me, I hope.
Dog? I hear him very well. So thank you very much for the invitation. It's a pleasure to be here. And this is my first venture into doing economic history. And I remember, so Refit must know who John Faust is. I remember saying to John, gosh, economic history is really hard. And he said, well, that's because you're finally doing economics. And there's some truth in that. We have a tendency to write down models that we can tweak and do things with, and then we think we're making nice points. And there's a great deal of value in that. But when you actually have to confront the reality, not just in the data, but also in the kind of political atmosphere and so forth, it makes it more challenging, but also I think in many ways more rewarding. So having said that, I'll get moving with the paper. This is joint with Maggie Jacobson, who's at the board, and Bruce Preston, who's at the University of Melbourne. And actually, of the three of us, Maggie is the historian. So the idea for this paper came to me one day when I was sitting out on my deck, thinking about the gold standard and realizing that once you leave the gold standard, government bonds become genuinely nominal claims. Before you leave the gold standard, while not the bonds are claimed, say, to dollars, those dollars are convertible into gold. And the government has to get access to that gold. Well, the only way they can do that is by raising taxes. So it occurred to me that in the story that we hear about the Great Depression and the recovery, this component didn't play any role. It surely played a role in terms of freeing up monetary policy, but the role that fiscal policy played in the recovery was always thought of as kind of operating through standard Keynesian multiplier effects, that kind of thing. And in those environments, government debt doesn't really play any role. You might remember from your ISLM days, I don't know whether most of you are younger, so you may not have ever had those days. Refit and I probably did. You remember this thing called the balanced budget multiplier. And the idea was if you raise taxes enough to pay for the spending, does the increase in spending still have any kick? Well, that's basically saying it's akin to just kind of eliminating the government debt consequences of the fiscal expansion. So that's the way that people have always thought about the recovery and the role that fiscal policy played. And what we are going to do is introduce a second role. Okay. So the thesis of the paper is that an unbacked fiscal expansion triggered America's recovery from the Great Depression. And there were two steps in this process. The first was a monetary one, which I've already alluded to. They reduced the gold content of the dollar, but then critically, they abandoned the convertibility to gold of dollars. And they also abrogated all the gold clauses on current and all future contracts. So what that did, so the way this used to work was that these contracts would say that they could be payable in gold. Now, once you do that, then it's no longer just payable in dollars. And so eliminating those gold clauses was really important for creating a genuinely nominal economy. Now, on the fiscal side, what Roosevelt did was he expanded government spending, financed through new bond creation. And then here's the critical step. He convinced people that these bonds would not be backed by taxes until the economy recovered. And I'm going to spend a fair amount of time talking about that and how he did it and why it's important.
I quickly ask, and if you're going to get to this, don't answer now, but is this any different from any country, going off a fixed exchange rate, or, Greece trying to get out of the euro when they were in a crisis?
Well, the problem with Greece would have been that they still had debt denominated in euros.
Well, that's your bit on the abrogated gold clause, right?
If they had
same abrogation would then be, right, whatever debt I have that says euro on it now says drachma on it, and you'd be done with that.
Well, then the question is the exchange rate.
Yeah.
Right. And the models, I was just going to say, the models I've seen that actually look at that question suggest that the exchange rate would adjust so dramatically that, effectively they were still in euros.
I actually have a question. So this may or may not be going against Christina Romer's 1992 paper. There, she talks about the living gold standard essentially working as unsterilized interventions. Because Roosevelt kind of deliberately didn't really want to go through the Federal Reserve Board to do any of this stuff, given the prevailing view at the board at the time. So there's a little bit of there's a murky area there, whether it's like it was really monetary policy or fiscal policy that was happening at the time. And I guess for the US, we have better quality data, so we can study this. Well, I guess for other countries, it's going to be very difficult because there's not much fiscal data at the time.
Yeah, I'm going to address exactly that question.
Okay.
What I want to say, and the reason I talked about there being two steps, is it's never just a fiscal story or just a monetary story. I mean, that theme, I think, goes back to at least Sargent and Wallace, and maybe before, that what happens is always about joint monetary fiscal policy. And so I don't want to sell a story here. I don't want you to come away thinking, oh gosh, it was entirely fiscal. And so I'm going to speak to exactly what you just raised. Okay.
Because in fact, I was going to get to that, because what I remember, if I remember correctly, at the beginning, there was a monetary force, then fiscal force slightly kicked in later. And is it going to be something that we're going to see in this paper too?
Well, we've already seen it in those two steps, that the first step was monetary, And
Okay, all right, all right. Okay,
that made government bonds genuinely
okay, fine,
nominal,
fine, okay.
which then allows the
okay.
second step to occur.
All right,
Okay.
okay, that's consistent with my understanding. Thank you.
Yeah. And that's what this next bullet point says, is that this monetary component was a necessary step for the fiscal component to kick in. And so therefore, everything is, I mean, the story I'm telling is about joint monetary fiscal actions. But what's really important here, and this is something that I think our policymakers tend to, they don't grapple well with this, is that this policy was explicitly state dependent, and it was intended to last only until the economy and the price level recovered. And that state contingent bit, it's clearly the way monetary policies operate everywhere. It's almost never the way fiscal policies operate when we think about, you know, say the COVID fiscal spending. And I'll come back to that also. Okay, so now why we should care about this, and I think this is really the message of the paper, is that, yeah, it's interesting to sort of reinterpret the recovery of 33, but more importantly, this has a very clear message for today, that since the financial crisis, in many countries, inflation was below target. Obviously, since COVID, that's not always been the case. But policies were pretty inconsistent. We had a very expansionary monetary policy, and in many countries, especially in Europe, we had very contractionary fiscal policies. And so those fiscal policies were not providing the appropriate backing for monetary policies to operate effectively. So the theme there is that these policies need to be consistent with each other if they're going to be effective. Since COVID, there's been a big expansion in debt finance spending. And this spending is quite explicitly temporary. We're clearly going through an emergency. So, you know, you don't need to have those backed by taxes. You could follow the Roosevelt plan in that case. And if it's unbacked, what we'll show you is that the demand stimulus is larger. But again, this requires coherent monetary and fiscal communication. So we may have a lost opportunity here. And in the United States, this is especially bizarre because the COVID spending didn't really bring forth any discussion at all about how the debt's going to be financed. And then we start talking about infrastructure, which might actually bear a positive return. And the whole discussion gets mired in how is it going to be financed? You know, it's just not terribly rational policymaking as far as I can tell. So, and this phenomenon of low interest rates, I think most people agree is not a fleeting thing. We've had a secular decline in long-term real rates around the world, and we're likely to be revisiting lower bounds on nominal rates fairly often, I would venture a guess. And so this issue of how can we most effectively deploy fiscal policy is going to keep recurring. Okay, so now let's go back to 1933, and this is a graph of the price level in the United States over the period of time when 1 ounce of gold was equal to $20.67. Okay, so this doesn't exactly coincide with the classical gold standard period, but it's meant to reflect a period when the US government more or less was credibly committed to the gold standard. And so what you can see is that, like economic theory tells us, under a gold standard with a fixed parity, the price level is going to be mean reverting. Of course, it can take many decades to revert to that mean. And the problem that Roosevelt was facing is summarized by the level of prices in the 1920s, which was about 60% above the mean. And so what had happened was a lot of farmers and entrepreneurs had undertaken debt contracts at these highly elevated price levels. Then the price level dropped precipitously, and that generated a very large redistribution of wealth. And that redistribution of wealth was a very critical factor in Roosevelt's thinking. Okay, so as I just alluded to, both Congress and Roosevelt were concerned about the debtors who had incurred their debts at these elevated 1920s price levels. And then when the deflation hit, the real cost of these debt obligations rose dramatically. And this generated an enormous increase in the household debt income ratio. We look at that as 80%, and today we think big deal. But back then that was a big deal. And farm foreclosures tripled in 1933. So Roosevelt was actually very explicit about calling for a permanent increase in the price level and Irving Fisher actually did some calculations about what the optimal price level would be. Irving Fisher had a lot of correspondence with Roosevelt. And, you know, more or less, it had come down to, we want to get the price level back to where it was in the 20s. And the thinking was that this would sort of confront this issue of redistribution, which I think was, from a political standpoint, very much in Roosevelt's mind, but it was also designed to try to stimulate the economy. Okay, so that was his objective. To do that, you required a substantial permanent revaluation of the dollar price of gold. In the absence of that, the gold cover ratio would have fallen below the legal standard. Now, under the classical gold standard, you cannot permanently raise the price level. And so it was fairly obvious that the first step had to be abandoning gold. Okay, so what is an unbacked fiscal expansion? And I'll have a little toy model to illustrate this. But what I mean by that is that you increase spending, and in the case of the Great Depression, that spending took the form of purchases, a fair amount of infrastructure spending, but also direct transfers. And you issue nominal bonds to cover the resulting deficit. And then critically, as I said, you then have to convince people that surpluses will not rise in the future to pay off these bonds. Now, if that nominal debt is not expected to be backed by higher primary surpluses, then that's going to increase households' nominal wealth. They're going to try to convert that into consumption, so demand goes up, and that's going to drive up prices and output. And that's the mechanism that would operate in any model where you try to do what I'm calling an unbacked fiscal expansion. And this unbacked fiscal expansion can permanently raise the price level. So one nuance here that I want to get across, because we're so accustomed to thinking about rates of change rather than levels. Roosevelt wasn't interested in having a permanent inflation. He wanted to just get the price level back up and then basically, you know, just have zero inflation from that point on. So that's why the term reflation is really what applies to Roosevelt's objectives, not that he wanted an inflation.
I mean, it's not just Roosevelt at the time, right? I think even like in the UK, they had the same conversation about the level of prices.
That's right. That's right.
Yeah. And
now
the whole
difference,
Ottawa conference was about the price level.
The difference in the UK was that they didn't take Keynes's advice.
Oh yeah, Keynes was really angry about that. So.
Whereas I will argue that Roosevelt did. Okay, so there was a triple-barreled approach. So you may not know this, but there is such a thing as a triple-barreled shotgun. Being an American, you know, we love our guns. So I'm here to tell you there is such an animal. So the first barrel was actions by the executive branch with the blessing of Congress to, as Sang Seok had said, to basically take control of monetary policy. The Fed was universally regarded as inept. And, you know, the response of the Fed to the initial downturn was, shall we say, counterproductive. That's something that is well documented by Friedman and Schwartz. And so the executive took charge and said, okay, we're going to reduce the gold content of the dollar, and we're going to make the decision to abandon convertibility. And now this is the really clever thing that Roosevelt did. He created this dual accounting system, and he distinguished between emergency spending and ordinary spending. And if you think about sort of trying to anchor expectations, that's what he was doing with this. So what he was saying was, hey, ordinary spending, you know, the salaries of government employees and the military and so forth, we're going to balance that budget, just like we always have. But the emergency spending, which was, you know, relief through these works programs and infrastructure and so forth, that we're going to finance by nominal bonds, and we're not going to raise taxes until we start to see the economy recover. And so the language of emergency was very important for kind of anchoring expectations. It communicated that what was going on was temporary, it was state contingent, and it was unusual. Okay, you can't always have emergency spending by definition. If you do, it becomes ordinary. And so he was saying, hey, we got something really extraordinary going on, and we got to deal with it differently than we deal with the usual things. And then the third component was political. And the reason that this is important is because, as I said earlier, as long as you're on the gold standard, you have to back government debt with future taxes. Otherwise, the credibility of the convertibility declines. So he had to somehow say, yeah, we're doing something unprecedented, and he had to act in a way that made it credible. And the way he did that was he made the recovery the priority. He talked about the Great Depression as more grave than World War I. And he feared agrarian revolution and amorphous resentment of economic institutions. There was at the time, this is a lot like the US in recent years, sadly enough, there was a dramatic decline in sort of confidence that the government was there to help you. And so part of the message, and that made farmers and other people quite unsettled. And so, and by the way, he also exploited the fact that there was stuff going on in what used to be called Russia around this time. You might remember that history a bit. 1933 was also a memorable year in Germany. And so he was able to tap into what was happening internationally to say, hey, we face a choice between a rise in prices or a rise in dictators. And he sort of elevated the importance of dealing with the economic crisis by saying that he's fighting a war for the survival of democracy. So these are powerful words, not ones you hear government officials say very often in response to an economic crisis. So all of that was designed to try to re-anchor expectations away from the way things had operated for the last 100 years, where debt was always fully backed by taxes, to an understanding that some of the debt might not be backed by future taxes because we've got to deal with this economic crisis.
So there are two issues here, right? One is convincing people that these unbacked fiscal spending is actually going to take place. And I'd say, of all countries, one that's perhaps the closest today is Japan, right? We're really going to allow inflation. The other one is to convince people that it's going to be, once that they're convinced of that, is to convince them that it's going to be one time.
Right.
That you're not suffering from this T0 problem where now that we know that we can do this, right? We're going to do this once and for all, once again.
Yes.
And how did that work out?
Well, I think that's where the dual budget idea comes into play. That what the dual budget does is it necessarily puts some constraints on how much inflation can occur. You're not going to inflate all your debt away.
That's right, but it assumes that the dual budget is a temporary thing, that the second budget is going to die on its own at some point, right?
Yeah.
And that the second leg is not going to get ever larger. I mean, the Turkish example would be, was it 1999? We had this huge earthquake and instituted the earthquake tax to pay for the rebuilding, which is still there, and nobody knows what it's paying for, right? So these earmarked stuff, once you realize that you can get away with it, there's a lot of incentive to continue to get away with it. So what's surprising here is that they actually did discontinue it once it actually worked.
Well, I actually think, if anything, Roosevelt erred too much on the side of conservatism here. And part of that was by 1936, he was looking to get reelected, and he had to come off being a fiscal hawk again. And so he backtracked. So I think the problem in the 1930s was almost the flip side of what you just described in Turkey, that the default was we're going to raise taxes.
Which is surprising. I mean, what is surprising here is that it really sounds like, very German, in the sense that, what is more likely to get you elected isn't spending, but committing to raising taxes and not creating inflation. It says something about the demographics and people's expectations too.
Yeah, I mean, the being fiscally responsible. I mean, if we go all the way back to when Roosevelt was campaigning against Hoover, he criticized Hoover for the deficits he was running. And I actually think, I don't want to build too much into this, because I think Roosevelt was ultimately a pragmatist. He would throw things against the wall, and if they stuck, let's try it. I don't think he was an ideologue. I don't think he cared one way or the other about budget deficits. He cared if they could do something good, then yeah, let's run them. And so in 1933, he thought it could do something good for the economy, and by 1936, he thought it could do something good for him.
So my impression from reading stuff from the time is that he didn't exactly know what worked. So the spirit was, let's try until something works.
Exactly, and that's what I mean by he wasn't an ideologue at all.
This is the conclusion of Bernanke's AR Papers and Proceedings paper on Japan. That just like if they are tried this, that, and the other thing until something worked, Japan should be doing something similar.
Yeah, but in defense of Japan, Japan is under an enormous amount of pressure from the IMF to get its fiscal act in order. And the IMF is constantly hammering on Japan, saying, you should be announcing a path for increasing consumption tax rates. And even when Abe postponed the tax increase a few years ago, it was just postponed. It wasn't canceled.
Yeah.
So the expectation in Japan seems to be eventually taxes will go up. And so they have a very hard time kind of committing to, we're not going to raise taxes until inflation increases. And part of that, I think, I do blame the IMF for. I think the IMF has a very old school Keynesian notion of how economies work. And, you know, what can I say?
I mean, this is not this talk, but it's the political economy of why Japan cares about the IMF is interesting, actually.
I'm sorry, say that again?
The political economy of why Japan cares about the IMF is interesting, actually.
Right.
I mean, you know, the IMF says all kinds of things about monetary policy in the US too. And I've never heard anyone, you know, begin a sentence saying, well, since the IMF says this about the US economy, right?
Right.
Who cares?
Yeah. Yeah. No, I agree. It's unclear. It's not like it's Paraguay or something, right?
Exactly. I mean, it's not like, let's be fair. It's not like Turkey, where you continuously think that, well, eventually we'll have to go to these guys hat in hand. So maybe we should be playing by their rules.
Right.
Anyhow, okay.
Yeah. Yeah. I think we are all, even us fiscal theory guys, are still scratching our heads about Japan. And I think in Japan, well, I think almost any time you talk about fiscal policy, you have to bring political economy dynamics into play. And I don't have any special insights about the political economy dynamics in Japan. And so I think I don't have very much to say. Okay, so emergency expenditures, and you'll see that there are a couple things to look at. First of all, there's this gold line, which is my contribution to this paper. That's when the US left the gold standard, so that you just get a sense of before and after. And so emergency expenditures were a large fraction of total spending, as this graph makes clear. Secondly, the black line here is the ordinary primary surplus, and the red is the total primary surplus. So you can see that, with the exception of this period, which was anomalous in this because it involved very large payments to war veterans. With the exception of that, Roosevelt really did deliver on his promise to balance the ordinary budget, but run deficits on the emergency budget. Okay, now I want to give you a little toy example of what I mean by an unbacked fiscal expansion, just so that it's sort of solidified in your head. So just take a representative agent with a constant endowment. We're going to go cashless, and we have no government spending. So utility depends only on consumption. There's going to be a 1-period nominal bond that sells at the price 1/1 plus the nominal interest rate. Households then pay a lump sum tax net of transfers of tau. And I'm going to peg the nominal interest rate at 0. That's roughly consistent with what interest rates looked like, at least in the early 30s. So the household's intertemporal budget constraint just says that the expected present value of consumption equals, over here is the expected present value of after-tax net of transfers income, plus their initial financial wealth. So they go into time period 0 holding a level of bonds of B -1. Now, if we impose equilibrium, so we have to make sure that goods markets and the bond market both clear. And we now distinguish between ordinary and emergency surpluses. I'm going to talk briefly about what the policy is and then get to the equilibrium. Okay, so ordinary debt is going to be fully backed by future surpluses. So there's going to be a tax rule that looks like this. As long as this gamma parameter, if it's bigger than 1 over the real interest rate, then what that guarantees is that if higher debt brings forth higher taxes, which in present value will then retire debt back to steady state. That's a sufficient condition for an equilibrium to exist. It's not necessary, but it is sufficient. And that's kind of the way they were thinking in those days was, we're not going to have debt growing over time as a share of income. And so just think about gamma as bigger than the real interest rate. And then I'm just going to treat the emergency. So here I called this emergency spending, but this is everything's lump sum to make all the calculations clean. It's taxes net of transfers. And we're just going to assume that that's a stationary stochastic process. So after we've imposed equilibrium on the household's budget constraint, we get this equilibrium condition, which those of you who are familiar with the fiscal theory will know and maybe love or hate. But it is an equilibrium condition either way. And so what this says is that the real value of debt outstanding at the beginning of period T has to equal the expected discounted present value of future taxes net of transfers. And you can write this sort of recursively like this, and I'll tell you why I did that in a minute. So you can decompose this into current taxes and then the present value of all future stuff beginning next period, okay? Now for the policy rules, policy behavior, what I'm going to do is that the emergency spending, because it's just a stochastic process, if you increase transfers today, cut taxes today, you then bring forth no change in the expected present value of future emergency stuff. That means that nominal wealth goes up, right? In households receive this transfer, they're expecting no offsetting taxes in the future, so they have more goods, and they try to convert those goods into a higher path for consumption. And that then is what's going to trigger the expansion. Ordinary taxes, on the other hand, are backed by future taxes. So any change in taxes at time T is exactly offset in present value by future taxes. So they're going to generate no change in wealth and therefore aggregate demand. Now, under Ricardian equivalence, basically all taxes are, quote, ordinary, right? And so all the ordinary terms just cancel out no matter what the equilibrium price level sequence is, okay? But once we have this emergency stuff, then that equilibrium condition, so what you can see here, if I just go back, I know I hate it when people do this, but I'm going to do it. What's happening here is this baby, the BO, is going to end up canceling with all the tau O's, okay? That's just after we've imposed that tax rule. So you end up with this equilibrium condition coming down to this. And
sorry, if this is genuinely unbacked, that tau e is a sequence of zeros, is it not?
No, it's unbacked on the margin.
Okay, help me a bit more.
Okay, so in other words, a shock to tau e today doesn't change the expectation of future tau e. But you could have a constant and say tau e is just a constant plus an IID shock.
Okay, so help me map the Roosevelt idea to the model, where I come in and say, you know, the way I think of this is there was no tau e, it was all tau o, right? There was just one budget, it was all ordinary, and everything was supposed to be paid back properly, right? I now introduce this, more importantly, B, right? I'm going to borrow, and I promise that I'm not going to fund this by taxes. That is, tau e is zero. Is this a wrong reading of what Roosevelt was doing?
Well, I mean, I think what we're doing here is we're trying to translate what he was doing into a formal setting. Okay. I know you got that part.
Even I.
And we're also imposing rational expectations.
Uh-huh.
So if there's absolutely no backing, either on average or on the margin,
Yep.
then this debt will have no value.
That's right. So that was my point, right? I mean, it seems like that's going to imply PT has to go to infinity. That's how your debt has no value.
If it has, and so all of this, I mean, all of this stuff is about what is the financing on the margin.
Okay.
And tau e could be, I mean, the mean of tau e could be arbitrarily small, right? As long as it's positive.
Okay.
So I think, I mean, it's not as though government debt lost value. I mean, all value during this period. So I don't think it's inconsistent with what we've observed. It may be, I think you're right. What's that?
Let me say this. I think the key here is, although there are different budgets, there is a, budget ordinary and budget, emergency E. There is no separation between debt ordinary and debt emergency, right?
Exactly.
And that's what's making all of this tick. Otherwise, it's indeed the case that the emergency debt should be worthless because you said that you're going to inflate this away.
Yeah. No, you're exactly right. And what I did, and maybe this for expositional purposes is a bad approach, was put the little O's and E's on the B's. If I hadn't done that and I go back to this, then over here we just have a B.
That's right.
And some chunk of that will get offset by the tau O's.
Right? I think I like that better in the sense that that's what implies, in the end, still determinate and finite P.
Yeah.
Right.
I agree with you. I think you're right. Yeah. I think that's right. I should tell you, by the way, this paper is under revision, and we're kind of reworking all of the theory. So that's a good point for us to keep in mind. Okay. Now, one of the important things here is that even a transitory cut in tau e will lead to a permanent increase in the price level. So my claim that unbacked fiscal expansion can permanently raise the price level emerges from this expression. Now, if you go to sticky prices, then of course this higher demand is going to get spread across real variables as well. Okay. So now I get back to the question about how this relates to what Romer has said. So the conventional wisdom was that the recovery was almost completely unrelated to fiscal policy. And that goes all the way back to this paper by Brown, but it's reiterated by Romer and Houseman and a bunch of other people who've written in this area. And the reason is because they looked at the size of the fiscal deficits, they looked at the size of the output gap, and they said no plausible fiscal spending multiplier could fill that gap. And so therefore, deficits didn't play any role. And here I want to introduce a little bit of language that comes from an old JEL paper by Coddington, where he talks about Keynesian hydraulics. And some of you may be familiar with A.W. Phillips' Moniac machine. It may be something that only us old people know about. But it was literally, and if you go to New Zealand or to the University of Cambridge, you can see this. He built several of them. What's that?
LSE.
Okay, there's one in Cambridge too.
But the one in New Zealand is actually working. The other ones are.
It is, right. The one in Cambridge I know doesn't work. But it is literally a machine where he describes the economy as flows of water. And now, of course, you might wonder, how do you get expectations into that? Well, you don't. And so Coddington refers to Keynesian hydraulics as kind of the textbook money multiplier transmission mechanism that many of us have in the back of our minds. And what I'm trying to get across here is that that's a pretty narrow view of what the transmission mechanism of fiscal policy is, because it's really entirely about real phenomena. That's why you can represent it through water, something real. There's no distinction in Moniac between real and nominal variables. And so the expansion that you can get through nominal demand from higher nominal debt in that environment provides no additional stimulus. So that's going back to this balanced budget multiplier idea that I alluded to before.
I don't understand the no additional stimulus bit. I mean, there is stimulus, right? The balanced budget multiplier is not zero. Or it would be.
Yeah, no, but it
does require rational expectations to be embedded in there.
No, but it's still entirely a real phenomenon.
That's right.
Yeah. So what I'm getting at is that the nominal component of the financing doesn't provide any additional stimulus.
Yeah.
Okay. So, and the way we do this in our current DSGE models is like through a tax rule that I wrote down before, where you have some lump sum taxes that just extinguish all wealth effects from government bonds. So the broader view that we're pushing is that you really need to add to those hydraulics the impacts of debt dynamics. And what you end up with is that multipliers are substantially larger when you have some unbacked component to the expansion. And this picture just comes from a off-the-shelf new Keynesian model. We just feed a serially correlated increase in government purchases in. And the solid lines are the pure Keynesian hydraulic part. So that would be where the debt associated with the fiscal expansion is fully backed by taxes. And the dashed lines are when it's unbacked. So on the margin, remember, this is a shock that hits. So on the margin, it's completely unbacked. And what you can see here is that in general, the expansionary effects are going to be substantially larger when this expansion is unbacked. And there's actually a very nice paper in the EER that delivers some analytics along these lines. Okay, so now I want to turn to some VAR evidence, because I mean, what's life without VARs? And I'm going to present two different models.
Can I ask you, before you go, I think it's okay when the audience demands it. Can you go back to the previous? Thank you. So think of all these people who say, oh, surely it wasn't the fiscal component because, there's no multiplier large enough. If you told them, the multiplier isn't whatever, 2, but it's 3, is that large enough?
That's a good question. I would have to, so the person who comes closest to actually quantifying that multiplier is Romer. She does it in a weird way as far as I'm concerned, but I should go back, and because I'm about to give you some numbers from the VAR about what the size of the multiplier is. And that's a really good point. I should come back to that. Way to go. It must be the tie. It really, it stimulates the flow of blood.
Unbacked tie. Go on.
Okay, so the first VAR is going to be really stripped down. And what I just showed you was that ordinary and emergency spending in the theory should have quite different effects. And first thing I'm going to do is show you that actually also happens in the data. So it's a very short sample. And for that reason, the use of the Sim-Ja prior is actually quite important. And what I'm going to do is just adopt the Blanchard-Perotti approach of treating spending as predetermined. And what you get, this left column is a shock to ordinary spending. And what you can see is that it has essentially no predictive value for the price level or for real GNP. Maybe, at 68%, you can say, okay, there's a little bit of significance here. If you turn to the emergency spending, first of all, what you see is that the emergency spending is more persistent. And secondly, what you see is that the responses of both the price level and GNP are substantially larger. Okay, so that's meant to just kind of whet your appetite that there may be something in the data that is consistent with the predictions from virtually any theoretical model that you write down that differentiates between these two. Now, I'm going to talk about an expanded VAR, which can get to the question that Sang-Seok asked earlier. You'll notice the first VAR had no monetary stuff in it, so we couldn't address the sort of monetarist story about the recovery. So we now have the primary surplus instead of splitting spending between the two. We have a short-term interest rate, a monetary base, gold stock, nominal market value of debt, and then the deflator and real GNP. And younger people tell me that this approach to identification is old school because I'm just using zero restrictions on the contemporaneous interactions. I do that without apology. So the first equation I'll talk about is what are we assuming about monetary policy? And this again is a point that Sang-Seok made. There was a conscious policy choice made to not sterilize gold inflows during this time, not over the entire sample, but over much of it. And so if we think of the money supply as the policy instrument, what this allows is for those gold flows to directly affect the monetary base. And then we also allow monetary policy to respond to this short-term nominal rate. Money demand is completely conventional. By the way, there are no restrictions on any lags in this. So all the zeros are on just the contemporaneous interactions. So money demand is of the usual sort. Nominal money demand depends on the price level, short-term interest rate, and income. And then fiscal policy chooses this surplus. It's permitted to respond to the state of the economy through the price level and GNP, and potentially also to respond to current debt. Okay, now this, I'm going to show you the responses to the primary surplus first. And what you see is a pattern that is pretty similar to what we were seeing with the emergency spending, that a decrease in the primary surplus, increase in the deficit, brings forth a higher price level and a higher level of GNP. And then it has very little predictive value for the interest rate, which is not too surprising if it's being pegged. And now you start to see some co-movements that I'm going to come back to. Those co-movements are that the monetary base rises, nominal debt rises, and monetary gold stock rises. Now, the standard Friedman-Schwartz story about the recovery, which is basically what Romer says, is that for largely political reasons, i.e. things that were going on in Germany, Europeans sent their gold to the United States. And so that sort of thinks about these gold flows as being largely exogenous to economic conditions. The paper talks about some other documentation about how actually the economic recovery itself induced gold to flow to the United States. But what you're seeing here is a pattern of co-movements where you have higher price level, higher output, higher monetary base, higher debt, higher gold stock. On the surface, you might say, well, wait a minute, that could just be the monetary story, right? Because that would generate those co-movements too.
That could just be the monetary story.
That's an excellent point.
But Roosevelt did it through the treasury, right?
Well, but there's another point here. What triggered this shock was the surplus. Okay. It's hard to see how, if output and the price level are rising, that would be associated with larger deficits. And so the point of the VAR is, well, we've identified an exogenous movement in the primary surplus. That movement generates these co-movements.
So
but I'm not done yet.
I apologize. So the one thing that is confusing to me here is the increase in the monetary goal, right? Up to there, I kind of, okay, I'm happy to take this. But with that, it really seems like the VAR is lacking some information, that it does seem like there is some indigeneity here. I understand that gold will be coming in and therefore happy to run a primary deficit. Because I guess in the causal story that is useful for you, why is the monetary gold going up?
Oh, it's entirely because of economic activity expanding in the United States.
It was the result of devaluation, right? So that made.
Well, that's the monetary story.
Well, no, it's not the devaluation.
I mean, gold.
The devaluation. Sorry, go ahead. What?
No, I mean the gold flow resumed after 1933. U.S. devalued, right, and that stimulated trade and everything because of the devaluation. That's the story. I mean,
yeah, except most historians don't think that could have triggered kind of the persistent recovery.
There were also problems in Europe happening, was adding to the political problems in Europe, adding to this gold inflow pressure as well to the US.
Yeah, I mean, I'm not denying that there's more than one thing going on here. What I'm trying to get across is that this pattern of co-movements that gets identified as the monetary story here is associated with a surplus shock. But I have a little bit more to say about this.
I mean, okay, so here's my bit. And this, I know you don't like to be questioned on your VIR identification, but, and I'm not saying this just to be, difficult and, ask, what if this, but I guess I grew up with the monetary story. right? So I'm gravitating towards it. And let's say it's the monetary story. Let's say I devalue. By devaluing, as a byproduct, I create a decline in the net present value of the government debt, which allows the government to run a primary surplus. It's not the primary deficit, right? It's not the deficit that leads to the price level increasing. It's the increase in the price level that tells the government, okay, I thought I had this huge real debt that I have to pay back. Now that I don't, I may as well splurge a little bit more. So how is that causality between the monetary story and the fiscal story identified?
Yeah, I don't think, well, I'll make an argument that it is, but there is a persistent observational equivalence point that goes on here. And this is endemic to any work, any empirical work on monetary and fiscal policy.
Can I just add one thing before we move on?
Yeah.
I think what I was trying to say is that, the source of gold flow may be this or that. You're completely right. There are many forces out there. But if you follow Christina Romer's interpretation, it was a deliberate choice by the Treasury not to sterilize the gold inflow, and that can be interpreted to be fiscal policy. Is this the point you're related to the point you're going to be making?
I would say it's related in the following sense, not because I want to label it fiscal policy, but because in order to sort of maintain low interest rates in an environment where the economy is expanding, you need an expansion in the monetary base.
Mm-hmm.
And I think the political dimension that you're alluding to is that Roosevelt didn't trust that the Fed would do that.
Yeah, exactly.
And so he took that out of their control and said, we're not going to sterilize.
Yeah.
So I see this pattern of responses as being sort of supportive of the basic story that you want to keep the interest rate fixed, do this fiscal expansion, and that's when you're going to get the most kick. I don't deny that there could be some stories that reverse this causality. But let me just tell you a little bit more about the evidence and see if that persuades you in any way. Okay, so I'll skip over this. This is basically just a story about how important these surplus innovations were in the data, and that very little of the surplus gets explained by other phenomena. So that lends some support to my story over Refit's story that the surplus was sort of just responding to other things. And then I want to just show you how big these multipliers are. They're pretty darn big.
Before you go there, what happens when you change the ordering of the surplus and money in that VAR? I imagine you're going to.
I'm not free to do that because I'm not. These are not being treated recursively.
So how is this identified then? How is money versus fiscal identified?
Well, in the conventional way, you look at what's on the right-hand side, right? And you see, okay, what can move M and not move S.
Right.
And vice versa.
Okay. I guess the link from M to B isn't built in there, right? That M.
No, there is another. There are other equations that I haven't bothered to tell you about.
Okay.
So there's going to be a B equation.
Yeah.
And because this is the market value of debt, I treat that as a quote financial variable, so it can respond to everything contemporaneously. Okay. So so that connection is there. And then I treat the goods market variables, output and the price level, as predetermined at a monthly. This is monthly data, so they don't respond to anything within the period, except their own shocks.
All right. I'll have to think about so I understand somewhat. Okay.
And gold flows are, we think about, we don't try to separate demand and supply for gold. So we kind of write down what we think of as the equilibrium expression for gold. And that becomes another equation in the model.
Okay.
Okay, so these multipliers are pretty big. And there are different ways to calculate these multipliers. And so I do them in a couple of different ways. The black line is that identified VAR that I just told you about. If we just do recursive orderings, we end up with multipliers that look very similar. This isn't too surprising given that statistically the surplus looks pretty exogenous. So you can mess around with the ordering and not have much effect. So now to answer Refit's original question, are these big enough compared to say what Romer would assert to make a difference? I need to answer that at some point, but I'm not going to do it today because I can't. Okay.
You'll have to come back.
Yes. Now the monetary explanations. So I'm going to talk about these without showing you pictures. The pictures are in the paper. So if you look at Friedman and Schwartz or Romer or this guy Steindl, all of whom sort of present monetary stories about the recovery, they describe a set of co-movements that they identify as evidence of there being a monetary source for the recovery. And so I then asked the question, can you get that pattern of co-movements from any other shock besides the surplus shock in the VAR? Okay, so I do identify a money supply shock, a money demand shock, etc. And what the paper shows is that we do not find that same pattern of correlations with any other shock. And so that gives us some confidence, again, conditional on the identification, that the story we're telling is more consistent with data. Now, the people who have told that story really haven't done anything sort of with a system of equations. And so it's hard to kind of compare what they've done to what we've done. You know, the Romer estimates some single equation regressions, which would emerge from the VAR if you restrict it sufficiently. But it's very hard to know how to interpret single equation regressions in the context of the VAR. So I will ask you to just look at the pictures in the paper and see if you're convinced, as I am, that those correlations don't come from other shocks. Okay, so now this recovery was actually very quick, at least in the beginning. It coincided with departure from the gold standard, and the economy turned around starting in April of 33. Over the course of 1933. So there wasn't a once and for all decision, this is what we're going to do with gold. It sort of evolved over 1933. And it wasn't until 1934 that it was finally settled on the price of gold being $35 an ounce, which was about a 60% devaluation in the dollar value. Now, some corroborating evidence to our story comes from this nice paper by Jalil and Rual, which documents that inflation expectations rose sharply beginning in the second quarter of 33. They attribute much of that to, or they infer that from contemporary news accounts and business forecasts, and they attribute much of that to FDR's communications, his speeches, his fireside chats, his press conferences, and so forth. So that again goes back to kind of this triple-barreled approach. How do you convince people that what you're doing is credible? And so the idea that expectations seem to pick up immediately lends some credence to that story.
May I ask? I mean, at this point, this is an embarrassing question, but I'll ask anyway. So it still seems like, in a sense, it is the monetary story that if you're able to credibly commit to creating inflation, right, that gives you a huge demand kick. But without the accompanying fiscal expansion that is unbacked, you wouldn't be able to do it. And that seems to be the mechanism. Is that more or less correct? That is, if I'm able to separate the primary deficits from the devaluation and, importantly, changes in expected inflation, and try to put marginal contributions to the recovery from these, is it not the case that the kick is actually coming from changes in expected inflation?
Well, it will be coming from expected inflation for sure. Yeah.
Right?
Now,
The
whether you
question
call
is-
that monetary or fiscal,
Exactly. Yeah.
is an
I mean,
open
I don't really
question.
care. I'm not that much after labeling things, but in a sense, this is kind of mildly related to, do I think that QE is working because it's a commitment device for keeping rates low in the future, right? Because I would actually want the fiscal policymaker to cooperate. If they are not, then this is the I guess 1930s reversed, where fiscal policy is inept, and therefore monetary policymaker is taking over fiscal policy and creating these future commitments that will have to be inflated away in a sense, as a way of committing to inflation or a reflation today. Is that more or less a reasonable reading of this theory?
I think so. I think it depends how far you want to take it. So Goiti Egerton takes it, I think, entirely too far. His story about recovery is that the central bank is optimizing, solving a time-consistent problem, and the role that fiscal policy plays is by having high levels of nominal debt, it encourages the central bank to keep nominal rates low for longer.
Okay.
The reason I find that story to be completely incredible is there was no sense in which there was coordination among the different regional feds back in this time. And so it's very hard for me to be convinced that the Fed was doing anything that resembled rational policy. Now, and in fact, if you look at the period that we're talking about, the Fed did absolutely no open market operations the entire time. So I just find it very hard to buy into that story. So you could take what your logic is and say, well, that's basically what Egerton's story is.
We run into this kind of identification problem throughout this period. For instance, when you think about Poincaré stabilization in France, like a decade earlier, fiscal consolidation and returning to gold happened at the same time.
Yeah.
So
well, that's not a coincidence either, by the way.
Yeah, right? Of course. You need to either leave the gold standard, enter the gold standard, depending on what you want to do. But the gold is, leaving gold in this case, it's a precondition to be able to engage in.
I would say that the problem of this observational equivalence is not unique to this period.
I threw out. I think at least I studied this period and period before a bit carefully across different countries. You have a terrible identification problem in some ways. I focused on monetary stuff because we have the data. But outside the US, we cannot get high quality fiscal data at higher frequency. So I think this is data problem.
I think you could in the UK.
UK, yes, UK. I think you can. In fact, I was going to ask a question related to this, since I'm glad you mentioned the UK. Have you looked at the war bonds?
What do you mean?
I mean, when you think about unbacked fiscal expansion, I think some of the UK war bonds were not expected to be paid back, and they were not paid back until very recently. So if you look at if you estimate the multiplier coming out of different financing sources, maybe helping with identification. I was just thinking that.
Yeah, I haven't thought about that. I haven't dug too deeply into the UK. I think that the story in the UK is actually very different from the US because they did not do the fiscal expansion. But beyond that, I don't have. And this is also before the war, remember?
Yeah, I mean, but yeah, leading up to the war, fiscal expansion happened. You're completely right. It's just that on top of that, what's happening is, I don't think public expected everything to be paid back. So I think it's probably worth looking at. Yeah.
Well, during wartime, it's always a bet, right?
Yeah.
Especially if you lose the war.
Of course.
Okay, let me just show you a little more corroborating evidence. So here's what the recovery looked like. This is the big recession that got blamed on increasing reserve requirements. It coincides, though, with a backtracking on fiscal expansion. So that's another twist to the whole story. Now, in terms of price levels, you can see they never actually got back to their stated goal. They did move up, and so we use this GNP deflator. But this was when he started to backtrack, and then you can see that the deflator actually started to fall again. So let me just talk about some other evidence. In this story, the revaluation of the government bond portfolio plays a central role. Through surprise changes in the price level, surprise changes in bond prices or expected inflation, and changes in real discount rates. And so we can look at some facts about government debt to see if they line up with kind of this transmission mechanism. So we look at a detailed government bond portfolio data. Nominal debt grew 20% faster than real debt. Now, my favorite picture, which I'm about to show you, is that despite the fiscal expansion, the debt GNP ratio was flat during this period. Real returns tended to be more negative during this period. Surprise devaluations were large and negative, and surprise inflation and lower bond prices were important. This is my favorite picture that I would like to show every policymaker. This period from the end of 29 until leaving the gold standard was when Hoover was running deficits, financing them with bonds. Bonds as a share of GNP rose. Well, that can only happen if people expect those bonds are going to get paid off in the future. Then, during a period where there was this, over this period, nominal debt grew by more than doubled. And over that period, right here, especially, debt GNP ratio was flat. It went up here. That's the backtracking that I was talking about. That's when Roosevelt started to support raising taxes. And now suddenly this expectation is, oh, I guess these bonds are going to be backed, not unbacked. And now if we look at the...
No, go back.
So you like this picture too?
I love the picture, but I want to understand it better. In the sense that, so this is, I guess, I mean, this is the value of debt, right? And it's stabilized because you are creating, in a sense, inflation. You're inflating away some of the debt. And that's
Well,
what's
it's two
making it-
things.
Okay,
The economy was growing and the price level was rising.
right.
So if you take the market value of debt, you divide by nominal GNP.
That's right. But I would imagine that the market value of debt is much larger than the growth rate of GNP, right? Or just me being Turkish. That effect wouldn't be all that large. I guess what I'm trying to understand here is the following. If I try to superimpose this against the primary deficits, right? Roosevelt was running a primary deficit. So something must be going up. And
Nominal debt.
Right. Okay. And so nominal. So okay, then what am I looking at? Nominal debt is going up, but this is what? This is
Well, you can think of it as nominal debt divided by nominal GNP. So it's the debt GNP ratio.
Okay. And so the price level going up, these both being nominal, isn't going to lower that ratio.
So it's got it. Some of it's going to, I mean, a lot of it's going to be growth.
Right. So I like this graph a lot, because if you told me to draw this based on what I expected to look like, this looks nothing like what I expected to look like.
Right.
Right. But I actually still don't understand it. That the inflation that's lowering real debt is also lowering real GDP. So that inflating away effect shouldn't be driving this. So it really has to be, the pickup was so fast that, despite we were running deficits, right, debt to GDP wasn't going up. And that's not an easy feat to pull off. This is the standards, growing your way out of debt story.
Well, except if you go back to that very simple model that I showed you, where we had BT minus 1 over PT, you can scale that by real GNP if you want, or not. Okay. If future taxes are constant, B over P is constant. So the shares of GDP is constant. So the only way that the value of debt can rise is if you're expecting the present value of surpluses to rise.
But that's the question, right? What exactly is it that I'm looking at? So that's the market value, isn't it?
In that model, that's the market value. Yeah.
Okay.
Because there's no maturity structure.
That's right. But it should also then affect the value of the debt that I'm able to issue. Right? Interest
that would be
rates
the new debt.
Or the new debt. Okay. So then it becomes a maturity issue that I expect inflation to go up. And since there is long-term debts issued in the past, right, holders of that are taking a hit. It's a transfer from them to the government that the government is now spending. And that's what's stabilizing the debt to GDP. Okay.
Exactly.
Okay.
And that's actually what this next table shows you.
I mean, I guess the point is, with one period debt, this wouldn't be happening.
Right, right.
Okay.
Yeah, the maturity structure is very important.
Yeah.
Yeah, and that's exactly the point. So what I do here is I just compare returns, nominal, real, and then the innovation in real, during the gold standard period just before and this unbacked fiscal expansion period. And you can see that nominal returns are pretty close to the same, but real returns are quite different. And the surprise in the real return, the innovation, is substantially negative during this period. So that's exactly what you were just saying.
Yeah. Yeah.
And I might add that what I said in the beginning about the redistributional goals that Roosevelt had, here they are. It was, okay, we're going to hurt the bondholders. And he called them the bankers. So that is playing a very important role in stabilizing debt. Okay, so let me wrap up with lessons from today, for today. At least at the beginning of all of this, Roosevelt was single-minded in his pursuit of economic recovery. And as I said before, you know, he was willing to experiment. He was not an ideologue. He made the fiscal policy explicitly state contingent. And he was clear that these emergency deficits were not going to be offset by surpluses. There was this joint monetary fiscal behavior that triggered this recovery. Nominal debt doubling played an important role in this, but so did the communication about fiscal goals, policy goals. What are we trying to achieve? And I think today there's a perception, I don't think people really understand fiscal inflation. They think about it through the lens of Phillips curve or something, I don't know. And it's perceived as a slippery slope. You know, it's like you can't get a little bit of fiscal inflation. The next thing you know, you've got hyperinflation. And I think what Roosevelt showed us was that need not be the case if it's carefully designed. The other point that I kind of hammer on is that governments also lack the single-mindedness that Roosevelt had. And if you look at, I've documented this in other papers, if you look at what the IMF was telling countries to do after 2008, initially there was no amount of stimulus that was sufficient, and then boom, there was no amount of austerity that was sufficient. Within a week of passing the stimulus package in 2009, President Obama was pledging to reduce deficits by 50% by the end of his first term. So this is a mixed message. We're going to stimulate, but don't worry, we're going to contract. And that mixed message undermines the potency of fiscal actions. And then the last thing.
Could I ask you before you go to the last thing? I mean, of course, this whole experiment was capped by the Second World War, so we didn't quite exactly see, you know,
exactly
the normal conclusion of it. But in a sense, if it's working correctly, this has to be the you know, mother and father of all temporary inflations, right? It really is a one-time reflation. So you're going to see inflation briefly, right? But it's really going to be price level moving from one level to another and stopping there. So there is no need for, you know, if your central bank is, at the time, you know, the notion didn't exist, but an inflation targeter, in a sense, you should see this as a one-time change in the price level, not any sustained inflation, and therefore not react to it.
Right.
Right.
Yeah,
and
exactly.
so that idea applies today exactly, right? You know, if this is right, then you really should be seeing this, well, you know, inflation is 6%, whatever thing, as okay, good, right? You know, we are reflating, getting to the new level. But then the question really becomes, okay, I guess one thing that is important in your model is it remains a rational expectations model. And if people are, you know, constantly learners, they put too much weight on recent observations, things of that sort, so that once they see inflation, they begin to expect inflation. They don't quite understand this fiscal thing. All they understand is, you know, holy crap, prices are going up. They will continue to go up, right? Then your policy might be working too well in the sense that you are too stimulative and the price level gets out of hand. And that's not impossible.
Yeah, no, I agree with that. I'm sorry. Go ahead.
If I may, I'm going to disagree with Rafat Hoca. As far as I understand correctly, your story relies mostly on the at least part of the expectations being non-Ricardian. I'm not sure whether that might work in the current environment because, you know, we are used to thinking like if there's taxation today, it will be backed by, you know, or let's say if there's stimulus today, it will be backed by some future taxation. So I'm not sure whether it's part of the expectations or part of the stimulus being, you know, non-Ricardian or perceived as non-Ricardian from the perspective of the consumers might work today or not. I'm not sure about that.
Well, that was part of my point about the messaging. If ever there was a time when people thought fiscal policy was Ricardian, it was 1933 because it had just been Ricardian for 100 years. And so how you communicate about this is really important. And, you know, I think institutions matter a lot in this. I look at my Congress and I think it's just such a mess. You know, there's no clear communication about anything. And so it's very hard to know how people are forming their expectations about future fiscal stuff. So I agree with you completely. That is a challenge.
You can't agree with her and me simultaneously. But I have a quick semantic question.
Well, because she's not wearing that gaudy tie, you know, I can agree with her.
You couldn't wear it if you tried to, so don't get me started. But I have a quick semantic question. I'm happy to agree with you, Selim, in the sense that do we want to think of Ricardian people as people thinking that all debt will be paid back, or people correctly internalizing the government budget constraints? Under the latter interpretation, the government saying, you know, I'm going to spend this and I'm not going to raise taxes for it, right? Me correctly understanding it and understanding that the value of the debt that is funding that bit is worthless, that's still Ricardian, that I correctly internalize the government budget deficit, right?
That's right.
So then I think Gülterim Hoca and I can be both correct.
I agree completely with the semantic point. And I always thought of the word Ricardian. You can do what's called a Ricardian experiment, or you can describe an equilibrium as Ricardian. I think when Woodford labeled a certain kind of fiscal policy as Ricardian, I think that was bad language. I think it confuses the nature of the equilibrium with the behavior. And so what I think you're saying, Refat, is that is really about describing what the nature of the equilibrium is. And some people seem to think that this equilibrium condition that relates the value of debt to future surpluses has something to do with Ricardian equivalence. It doesn't. It's just an equilibrium condition. That's like saying the Fisher equation is related to tax smoothing or something, you know? So
I'm happy with that.
Anyway, I don't need to say any more about this. I think we can wrap it up.
Let's do that. Very good. So this was excellent. I think we got lucky that Eric is here. Not lucky enough that he's not physically here, but we're going to rectify that hopefully when we are all flying around. But thank you so very much for this. And I'd like to thank this group here too. It was a fun seminar last week. It's a great seminar this week when people participate. So we're going to give Eric a few minutes off, and then he's going to have some office visits. So he should have time to have a cup of tea or whatever it is that he's having. Outstanding.
Okay.
And thank you so very, very much again.